Ladies and gentlemen, it's time to address what's been on everyone's minds: the increasingly worrying state of China's economic slowdown. Once again, instead of concrete solutions, we are served a delightful buffet of vague promises, old slogans, and toothless policies that only lead us deeper into the economic abyss. Let's talk about the latest buzzword: timely incremental policies. There's something profoundly ironic about the word timely here. Is there anything timely about policies that arrive years too late? Or how incremental has become a euphemism for barely significant enough to notice? Does this feel familiar? It's the same old tale. Announce policies, rally the sentiment, and cross our fingers that people forget that implementation lags behind. But as we dig deeper into every word Premier Li Qiang uttered in his speech, it becomes clear: China's economic issues are far more deep-rooted than we're led to believe. So today, I'll dissect his vague proposals, subject them to scrutiny, and unveil the underlying issues that plague China's economy. Imagine telling a doctor you're facing a severe health crisis, and they simply say, "We'll treat it eventually, in a timely manner." Would you not be concerned? That's exactly the situation Chinese citizens and investors are finding themselves in. Let's take apart what Premier Li is actually saying. Timely incremental economic policies. Where are the specifics? Listening to opinions from all sides. How many voices does the party permit to speak freely these days? Building consensus and confidence. Confidence? Haven't we heard this so many times before? While Li claims that new economic measures to propel growth will arrive in a timely and incremental manner, we know that when it comes down to execution, the timeline has been anything but timely. Policy paralysis has become the norm, delayed by bureaucratic inefficiency, and those supposed incremental changes rarely lead to substantial impacts in reversing the structural deficiencies. And that's problem number one. We're dealing with far more than short-term challenges. We need to acknowledge ongoing structural problems in China, including productivity stagnation. Since 2010, China's productivity gains have significantly slowed down. In fact, according to the World Bank, China's total factor productivity, TFP, growth has shrunk to just 1.5% in recent years, compared to greater than 6% in its peak years of breakneck economic growth. Investment misallocation. Despite relentless stimulus and infrastructure spending, returns on these investments are diminishing. Infrastructure projects, roads, bridges, ghost cities, are built not because of market demand, but because of government directives. According to academic research from Tsinghua University, an estimated 25 to 30% of infrastructure spending generates little long-term economic benefit. Debt bubbles. As China's economy becomes more dominated by state-driven capital allocations, corporate debt has soared to dangerous levels. In 2023, China's non-financial corporate debt was estimated at 159% of GDP, one of the highest levels in the world, leading even financial professionals to express concerns regarding liquidity traps and potential defaults. Now Premier Li tells us they're on it. They're aware, of course, hence the focus on addressing prominent issues in economic operations. But therein lies the rub. Some of these prominent issues are fundamental to the economic model China has built since the late 80s, and no vague statement of future action is going to fix decades of flawed development overnight. Ah yes, next on the docket: building consensus and confidence. The government has been touting the need for policies to boost investor confidence. Look at last week's stock rally after another batch of stimulus measures were released. Like clockwork, investors saw the announcements and jumped on the bandwagon for a hot minute. But when the pomp and circumstance wears off, what really drives investor sentiment? Let's look at the distress signals Chinese markets have been sending for years. Capital flight. Over the last few years, we've witnessed massive flows of Chinese capital abroad. Why? Wealthy Chinese elites and companies don't have confidence in their domestic economy. In fact, China's outbound foreign direct investment (FDI) hit a record high of $240 billion in just 2021, while inflows substantially lag, slackening of foreign investment. In recent quarters, foreign capital has been showing increasing hesitation. Think about the June 2023 Goldman Sachs report, showing slowing international investment into the Chinese market. Even global companies are shifting supply chains away from China, often relocating to Vietnam, Malaysia, or India. Stock market malaise. Sure, Chinese markets tend to rally after policy announcements, but these are short-term sugar highs. By the subsequent days or weeks, reality creeps in, and the energy fizzes out. It's important to note that between 2021 and 2023, the Shanghai Composite Index actually decreased by nearly 4%, while global equity markets generally rose. There's a pervasive lack of trust in the sustainability and transparency of China's policy direction. And the word confidence, repeated ad nauseum in Premier Li's speeches, becomes ever more hollow as skepticism regarding the government's stop-start economic management grows. Let's turn our attention toward that elephant in the room, the never-ending real estate crisis. Premier Li, along with the People's Bank of China, reiterated their plans to lower mortgage rates and promote stability in the housing market. This should right the ship, right? Hold on. You cannot fix structural issues with interest rate cuts alone, and that's been proven time and time again. Addressing the housing crisis by lowering rates boils down to a patch on a fundamentally broken system. Remember Evergrande? One of the world's most indebted real estate giants? According to leaked documents, they alone had more than $340 billion in liabilities. This isn't just a corporate mismanagement issue. It's a symptom of overspeculation and unsustainable growth, a rampant problem in China's overall real estate sector. To underline just how terrifying this problem is, the real estate market makes up roughly 29% of China's GDP, according to estimates from Nomura. That's monumental. Without significant restructuring, this crisis has the potential to bring the entirety of the Chinese economy to its knees. How does lowering mortgage interest rates fix massive corporate debt and years of over-leveraged real estate development? It doesn't. Instead, the goal appears to be kicking the can further down the road, hoping that consumers, many of whom have already been burned by property bubbles, will suddenly feel confident in buying more housing. Moreover, monetary policy can't fix what is clearly a structural problem. The Minsky winter has been whispered loud and clear. That is, the once booming housing sector couldn't sustain runaway prices forever. Eventually, all bubbles burst. And here, conjunctural policies like interest rate cuts barely mask a much larger issue of structural imbalances. And the real proof is in the data on realty consumption trends. Housing sales in China dropped another 28% year-on-year in August 2023, continuing the country's real estate sector turmoil. Despite governmental efforts to boost confidence, there was little change to actual buyer behavior. People's distrust is clear. Why buy a home when the value may plummet further? Now, it's nice that the People's Bank of China decided to step into the light by saying they're committed to implementing prudent monetary policy efficiently. But let's dig into the less sensational reality behind this. For several years now, the real efficiency of China's monetary policy has been deteriorating. How so? Well, China's obsession with credit-based growth is starting to backfire. Think about it. Local governments in China are essentially running on massive debt, pouring more borrowed capital into needlessly extravagant infrastructure projects to hit their GDP targets. But when the returns on these loans don't materialize, the debt piles up, leading to liquidity crises. The debt-GDP ratio of China, which is nearing 300%, is a glaring red flag. If China's goal is to sustain growth on the backs of its monetary engine, there is only so much leverage to squeeze. Prudent monetary policy, Premier Li says? Sure. But in reality, monetary efficiency has already been compromised by over-leveraging, mismanagement, and reckless spending. So, to tie it all together, incremental policies, confidence building, prudent monetary approaches, lower mortgage rates, if this all feels like versions of the same recycled narrative, that's because it is. Empty promises masquerading as timely economic action. We are witnessing the drip-feed management of multiple crises, from the implosion of the real estate sector, over-leveraged debt, shrinking productivity, to shrinking productivity, and investor sentiment that's hanging by a thread. These aren't just bumps in the road. They are structural weaknesses that have been building for years, symptoms of a system that is trying to defy economic gravity. Now, you may ask, can China overcome these challenges, or is this economy verging on irreversible decline? Well, if the trajectory of these policies and their tepid, unconvincing execution continues, the answer does not look promising. China's policymakers might buy time through stopgap measures, releasing one stimulus package after another. But it's clear that without real, bold structural reforms, we're not looking at cyclical downturns anymore. This is shaping up to be a long-term economic stagnation, if not outright decline. As China continues its painful economic transition, the burning questions that both ordinary citizens and professionals alike are asking remain. 1. How long can China hold onto its credit-driven growth model? The days of high investment returns on infrastructure projects are over. The overstretched balance sheets of local governments and massive corporate debt highlight this reality. Sooner or later, someone's going to have to foot the bill. 2. Can the real estate market be revived? With roughly 70% of Chinese household wealth tied up in real estate, it's more than just an economic lever. It's a social one. Will mortgage rate adjustments suffice? Or is the housing bubble too far gone to reinflate? And more critically, will citizens still invest in housing when the government continually proves that over-reliance on this sector has backfired? 3. Is the rise of other emerging markets inevitable? As Vietnam, Indonesia, and India court foreign investors, China is no longer the default destination of choice. Supply chains are tangibly shifting, and capital flow diversification is taking off. In fact, according to World Bank data, Vietnam's manufacturing sector grew by over 8% in 2023, while China's struggles culminated in a GDP slowdown amid a weak global export market. If this trend continues, skepticism about China's future as the world's factory will only grow louder. 4. What will happen with China's tech sector and its potential as an innovation hub? China's leadership talks about attracting investment into high-tech industries, but geopolitical tensions and internal crackdowns on tech firms have pushed against this outcome. Look at companies like Alibaba and Tencent, once pillars of China's economic miracle, now contending with regulatory pressure, sizable domestic competition, and a global market that's increasingly wary of Chinese tech giants due to political risks. At its peak, Alibaba was worth nearly $900 billion in 2020, only to drop 60% the next 2 years following state crackdowns. The talent flight that ensued from these overbearing regulations has only exacerbated the problem. Let's address the real issue here. The Chinese government is not willing to take the painful yet necessary steps to transform the inefficient sectors of its economy. Cutting interest rates and shouting about boosting confidence might buy time, but it doesn't fix the core issues. What China urgently needs is profound structural reform, including reforming bloated state-owned enterprises, SOEs, which hog resources and crowd out more innovative, productive private companies. For example, China's SOEs still account for roughly 30% of GDP, but they are systematically less profitable than their private counterparts. Research from the OECD shows that SOEs exhibit lower returns on assets, ROA, and productivity, but the loans continue to flow in these politically entrenched organizations. Addressing the demographic time bomb. China's population is aging rapidly, and 2022 marked the first year of population decline in 6 decades. According to the United Nations, the working-age population could shrink by around 200 million by 2050. A shrinking labor force means lower growth potential over time unless productivity dramatically increases. A tall order for the current trajectory. A broken social safety net. China's healthcare and pension systems are grossly underfunded, meaning an aging population only further exacerbates budget shortfalls for future growth. In fact, a city like Anshan in Liaoning province has already made headlines for draining pension funds to critically low levels, highlighting just how severe the problem could become on a nationwide scale. More significantly, people are starting to lose faith, not just in the government's economic policies, but in its narrative altogether. We've seen a rising number of protests and demonstrations, ranging from COVID lockdowns to homebuyers demanding justice due to unfinished properties. The social contract that has long existed between the Communist Party and its people, economic growth in exchange for political compliance, is fraying. If the promise of endless economic expansion vanishes, how long before this discontent boils over into a larger political crisis? China's mounting economic troubles also hold global implications. As one of the world's largest economies and a major trading partner for nearly every country, prolonged stagnation could pull down global growth figures. Particularly in the Asia-Pacific region, nations like South Korea, Japan, Australia, and emerging markets which are deeply integrated into the Chinese value chain may feel significant pinch points. In conclusion, it's critical we understand that China's economy is approaching a moment of reckoning. The government continues to parade initiatives that aim to prop up confidence, But the deeper, more structural issues can't be so easily glossed over. These challenges are not just part of a brief slowdown, but a symptom of a far more dangerous trajectory towards long-term stagnation. Premier Li's remarks about timely incremental policies and building consensus may sound reassuring on the surface, but the real results are years away and may not ever materialize if the current system isn't structurally reformed. China is dangling on the edge of a fiscal cliff, fueled by a disillusionment with temporary policies and deferred problems, rather than a genuine, lasting solution. Unless true reform is on the horizon, we could be looking at the beginning of a long, slow unraveling of the Chinese economic growth miracle. Moral of the story, folks: treating a sinking ship with a patch job only delays the final plunge. China may use its short-term measures to keep its head above water, but without drastic reforms, preferably before the current decade closes, the entire ship might sink. Now, whether or not Premier Li's timely measures will truly arrive on time is still up in the air. And how will the rest of the world deal with what could be one of the largest slow-motion economic train wrecks in recent history? Only time will tell. But while we wait for China's policymakers to study their next steps, one thing is clear: the clock is ticking.